Welcome everyone to Startup Grind. My name is Lauren Baxter. I'm your host tonight, and I'm very excited to be with the gentleman from Canal Partners. We will go ahead and kick off this talk in just a minute to say thank you to our sponsors, Hool Curry Law. Thank you, Hool Curry, for sponsoring us, especially this year. What a year. They will continue to sponsor us next year. So hopefully we will return to in-person events, and you can ask Connor and everyone else at Hool Curry Law some good questions. But if you ever need any help, they're a great resource, and they are here right in the Valley. Downtown Phoenix, Miss Sarah at Downtown Phoenix, thank you so much for being our sponsor this year. If you're interested in downtown, looking for space to host a meeting, an event in the future, I'm being optimistic, please connect with Downtown Phoenix. They're a great resource and free. And then Galvanize, for our two events we hosted in person. Thank you so much for being our partner, Seed Spot and Yes PHX. This is my last event as the director of Startup Grind. I have been doing this for 2 years, loving every minute and meeting some absolutely fantastic people. So thank you for listening to me moderate and all my little antics. And I will be naming the new director pretty soon. So if you're interested in attending events next year, virtually and in person, just sign up for our email list, and we'll be kicking off our events probably January, February. We'll see how fast the transition moves over. So that's all my announcements for tonight. We keep it short and sweet. We're going to get right into the conversation with the gentleman from Canal Partners. So to kick off, I want to learn a little bit about each of you. You have fascinating backgrounds, and we're going to put Todd in the hot seat. So Todd, if you could take about 2, 3, 4 minutes and tell us a little bit about your journey in your career. You are definitely the definition of a serial entrepreneur. So let's kick it off. You're the managing partner of Canal Partners.
Thanks, Lauren. Thanks for having us. We're delighted to be here and excited to do our first Startup Grind virtual event. So my career really started right out of college, and maybe it's because I couldn't get a job. Started a company with my dad in the HR payroll space, which today is more commonly known as PEOs or outsourced payroll, like Paycom, Paylocity, those kind of companies. And we started that in 1990 and really built that up as a bootstrap startup to get it to the point where we took it public. And then I exited in 1996. And then from there, made a little bit of money off that startup, and then started doing a bunch of other things like restaurants, sports nutrition, a couple software companies. I co-founded NetTime with 2 other gentlemen in Phoenix that are kind of well known in the startup community, Hamid Shojahi and Behan Sadeh. We did NetTime, sold that to Paychex, and really just always had a affinity for startups because I love the energy. I love the strategy. I love how, people are like all equal. There's no boss to lower level. Like everyone's in that room trying to figure it out. We all wear a lot of hats, and you do what you need to do just to keep it going. It's like, make sure that customer doesn't leave and make sure you get that new customer no matter what. And I just love the thrill of it. I love the adrenaline, the excitement. And I don't know, I've probably done 10 startups in my career.
So
I'll have another one in me. But I was always smart because I don't think I was ever a founder of anything. I was always co-founders with other people. Gotcha. So I always wanted really smart people around the table where we can utilize our skill sets properly. And, we were successful on some, not successful on others. And I think we learned a lot along the way, which is what we're trying to give to our CEOs and founders today at Canal, of the experience that we've went through as founders ourselves, and trying to really help them avoid the pitfalls and the speed bumps that we had growing our startups and companies.
Yeah. And quick add-on question. How was starting a company with your dad?
It's easy. My dad is the salt of the earth, the sweetest man alive. I think it's probably the role that question should be asked to him.
Okay.
Harvey is love Harvey.
Yeah, everyone loves Harvey. He's a great guy, salt of the earth. And I was the one that was probably a little bit more difficult to be a co-founder with, a little bit more spunky and defiant. But it worked out great. And we hired some terrific people from the start there that really helped our success.
And what a cool experience to share with your dad. Wow. Well, thank you. And let's go to Perry Jacobson, partner of Canal Partners.
Good evening, everybody.
Good evening.
Thanks for attending. I got here kind of in a convoluted way. I started my career back on the East Coast on the New York Stock Exchange. I was a professional market maker for 20 years. We sold that company, and I wasn't planning on doing much. And a buddy of mine said, listen, why don't you come join my private equity company? I said, well, I don't know a lot about private equity, but he said, you know what? I got a feeling I could teach you, and you've got a good knack for business from all your years on the floor of the exchange, looking at all these hundreds of companies. So I started back then about the same time I met Todd. Todd and I met, we met on a vacation, my second honeymoon, and he was on a vacation with his wife, and we met on a boat on our way to Capri, Italy, but that's another story. And I started with the Brookstone Partners back in the East Coast, and I was there until just recently when Todd managed to pry me away. I'd been coming out to Phoenix area for the last 15 years since I met Todd. I bought a place here about 4 or 5 years ago. And over the years, Todd and Canal and my old firm had a lot of interaction. And finally, I decided, you know what? I'm going to move out here. I'm going to join Canal. Todd and I and Chad are going to do some good things. And here we are.
Not to toot. Well, I mean, you were the youngest floor governor on the New York Stock Exchange.
I was at one time the youngest seat holder as a membership. I was 21 in a couple of months. I think that changed after about 15, 20 years. But yeah, I was the youngest floor governor, which is an honor. Other floor brokers and directors have to vote you in. So yeah, it was exciting to do that. And I saw in my path on the stock exchange, I saw a lot of interesting things with companies and quick announcements and quick decisions. So, I got to analyze a lot of stuff, which has helped me a lot in my career afterwards, even though it's a little bit slower pace.
Yeah. Little add-on question for you: East Coast versus West Coast. What do you feel is the biggest difference?
Well, first of all, I think the weather makes a big difference.
Yeah, we're a lot happier over here.
I find that people are more relaxed out here. I think they're more into health. They care about how they feel, what they eat, what they do. And it's not quite as crazy, frenetic pace like you have in New York or Boston. Those places are go, go, go. They can burn you out pretty easily. Here, we get done what we have to get done in a calm, systematic, interesting way, and it's really a great experience, especially hopefully when we get done with the COVID issue and we start meeting again in person more often, that will really help the experience.
Yes, I think
and I'm a big golfer, so I love the golf.
I was just going to say, you're going to find Perry on the golf course. Last but not least, Chad Horstman, partner at Canal Partners. Chad.
Sure. Yep. I started my career out of ASU with the startup company called iCrossing. At the time, it was about 15 or 20 people. And I spent 4 years there helping it become a pretty large internet agency, and went on to become one of the biggest internet marketing agencies in the world, and still headquartered here in Scottsdale. So it's pretty cool that I was involved in that. But I got to learn all about internet marketing before there was probably even one internet marketing book on the shelf, and there definitely wasn't any at ASU. And so that was just a great experience for me, and that kind of led me down the path of wanting to be an entrepreneur and use the knowledge that I'd learned through my time at iCrossing to start my own online businesses. So I started a couple different things, and the one a cigar site, a pepper spray site, product review site, and the one that really took off was a company called Yandy.com, which was, or still is, sexy lingerie and Halloween costumes. And it was the right time and the right place and very little competition. And I used that knowledge that I gained to really launch that company from nothing, from your garage startup to a 48 million revenue company. So I exited that about 5.5 years ago now, and was, I guess, somewhat retired there for quite a few years and really bored. I started hanging out with Todd. I'd invested in a few of Canal's deals, and got to know Todd better, and he had me look at some companies with him, and just I thought we were just hanging out, but eventually Todd broke the ice and said, would you want to join me at Canal? And so I jumped at that opportunity. In the meantime, during this pandemic, with the even extra downtime, I also started 3 startups with some co-founders, kind of the Todd model. So I have a company called greensupply.com that sells masks. That's done very well.
Link in bio. Link in the
chat. Crazy new products on the site right now. And so that's obviously done well. That was going to be a CBD site, hence the Green Supply name, but we transitioned to masks. And then I bought an old competitor called 3 Wishes. So that's another lingerie site. And then I launched a basketball site called basketballnews.com. So those are three passion projects of mine, and along with being a partner at Canal, that's kind of how I got here and what I'm up to.
So,
and he's not allowed to do any more. 3's the limit.
I know. My follow-up question for you.
Oh, I'm not doing that.
There's multitasking, and then there's you. How do you balance all of that?
Well, I have good co-founders. I have a CEO at each company. So really, it's just about 2 or 3 calls a week, really.
Okay. Okay, because I saw that in your bio, and I was thinking, oh my gosh, when does this guy sleep?
Maybe.
So the common denominator is if you hang out with Todd, something's going to happen. He's going to talk you into something. You find him on vacation, or you have a chat with him.
He has a newborn.
Yeah, I have a baby, so I bit off a little more than I could chew. But yeah, having the co-founders is really helpful.
Yes, absolutely. Well, let's kick it off into more about Canal Partners. So I'll let you all ping pong off each other, but how did you personally choose to get into capital investing? And, obviously you spoke with Todd, and Todd, we'll start with you because you came first. What made you get into this space after being a founder of so many companies?
So in about 2006, I didn't have a startup, and I was just sort of investing in companies, real estate, stock market, whatever. And I was just investing and looking at a lot of companies. And I invested in an internet company that was based here and in San Francisco, and we sort of took it over. And then I came across one of my investors who had a affinity and a desire to join my team, join me, really, it was just me, and start a company. And that was Jim Armstrong. Jim's the founder and former CEO of JDA Software. I think it's called Yonex now. And so Jim and I, from 2008 till really a year ago when he retired, we were Canal, investing in early stage startups that want between 1 and 5 million of capital, that have at least $1 million of revenue in the software space. But I just really, the capital side was great. I really like that, but I really like coaching and sitting down with founders and CEOs, hearing their problems, talking strategy, raising the roof on the energy level of just what can we do, and almost being like an adjunct to like a co-founder or C-level person at the company. But not having to do all the work and worry about it when you're sleeping, So it's like you get that energy, you get that high, you get that excitement, but you don't have to do all the work. So I love the coaching part, the board stuff. And then obviously making money is fun too for us and our investors. So, it's a great job. It's a great career, and I think there's a need for it. But as with everything, you got to pivot with the market. And as you know, we've talked to you about it, like we're pivoting a little bit from doing pure SaaS to more subscription of anything businesses. So we're looking at other things right now.
We'll go into that a little bit more too. Chad Perry, what made you come over to the dark side?
If you go back to my background, again, I was in public markets for a long time.
Yeah.
And I realized that you're at the mercy of someone at the public company who's going to give you some of the information that you might or might not want to hear, but you're never getting all the information. So when I got out of that, I started investing again with a private equity venture capital firm in smaller companies. And I found that I really like the fact that you can get your hands dirty and get down into the nitty gritty, and you don't have to worry about somebody else giving you good or bad information because you're got boots on the ground.
Yeah.
And I felt a lot safer investing other people's money and my own money in something where I had direct control, or at least very close to direct control of what was going on and how things got executed. So this is coming to Canal is just an extension of that. But we do the same thing. We get our boots on the ground. We find a co-founder or somebody who wants to partner up with us, and we help them. And sometimes they help us. Sometimes they'll help you in some of your other ventures. There's connections to be made everywhere.
Absolutely.
And put 2 and 2 together, and sometimes we get 6, so it works out pretty well. But it's really the move from public domain to the private domain was really attractive to me. And
why Arizona for you, since you hadn't?
To be honest with you, I came out here to visit Todd and play golf, and I just fell in love with it. So, if I could work, play golf, hang out with Todd and Chad, what more can I ask for? Perfect opportunity for me.
And Chad, what about you? I mean, I know you were bored after it in 2006, I think it was. You're on mute.
Because they might be crying in the background.
Hey, we're all at home, so cry away.
That we like to make money, and Todd's done very well, and I felt I could learn a lot from Todd, and I'd invested in Allbound, which was one of the Canal deals, which was doing really well, and Canal has a history of doing quite well. So that was obviously the main motivation. But besides that, of course, I wanted to do something that would be fun and enjoyable. And for me, going on those initial meetings with Todd to meet companies that were looking for funding, it felt a lot like being on Shark Tank, which was one of my favorite shows.
Every Friday night.
You just get these entrepreneurs that are in the thick of it, and they're, so passionate about what they're doing, or at least, you hope they are. Most of them are. So you come across those companies, and it's just fun meeting with them. And then when we do find one, it's great to work alongside them and help them and guide them and just be involved in that without having to actually be in the hot seat. So we get to kind of just be involved in a certain level that I think is enjoyable and hopefully make some money.
Kind of like me being an aunt. I just give the kid back. You're like the best aunt and uncle. So and obviously things have changed a little bit, but what type of companies do you invest in so you can share with our audience and audiences that will see this in the future, and what stage? And you can talk about in the past and then now. I know things have changed with COVID in the last 2-3 years Todd was talking about, but yeah, what kind of companies do you invest in and what stage?
So we basically invest in companies that are at 1 to 3 million in recurring revenue. But at this point, like Todd was kind of mentioning, we're opening it up beyond just software and anything that has a subscription to it. So that's the basic what we look for. We're pretty wide open in terms of industries at this point.
Any industries you prefer? You have
software if we could find it. But
Yeah.
from what we've seen, the valuations are just really, really high in software right now.
Mhm.
You know, to a point where we don't think there's value there potentially,
Gotcha.
especially, you know, if things change in the market. But so, you know, if we can find software that still has value in it, and we're still talking to some companies, but right now, you know, we feel we need to cast a wider net and kind of look into different industries as well.
Todd, Perry, anything to add?
Yeah, I think Chad really hit it, you know, on the head. I think we've issued maybe 10 term sheets in the last 2 years, and we haven't got one of them. So we're value-based venture capitalists. You know, like you have value-based, you know, small cap stock guys in the market. You know, we're value-based venture capitalists. And maybe it's because we're a little older, or at least me and Perry, to where I remember a day like the public company I was involved in, co-founded, we trade on EBITDA. You know, we really were a subscription company, but back in the 90s, you trade on EBITDA. And, you know, that magically changed kind of in that 2000 window. And then everything started trading on growth and revenue. And now, like Chad said, you know, there are companies, you know, that there's 2 reports just came out this week by some of the well-respected investment bankers. And they both said, if you're growing 40 to 50% a year, you're going to get between 15 and 20 times revenue. So think about that. If you're growing like 50% or 40% a year, you're going to get 15 times annual revenue. And most of these companies are losing money almost exclusively. So maybe it's just because I've been around where things traded at 8, 9 times EBITDA, and now they're trading at 15 times revenue for companies losing money and probably will continue to lose money for a while. It's just maybe psychological and a false belief I have. But, you know, when we can get 15 times multiples for our companies, we're going to sell them. You know, it's just because we're typically getting in at a much lower multiple at a much smaller number of revenue. So, but we're also not going to pay $35 million pre-money valuation for a $2 million revenue company. So, you know, it works both ways.
I've noticed
Makes logical sense.
People have approached us and we've met with, they all love the team, Todd or Chad or myself, and what we have to offer. And sometimes it falls through because at the end of the day, our valuation based on what we can offer tends to be a little bit lower than what some people just throwing money at a lot of different things comes up with. So, you know, as much as they'd like to have, you know, Todd or Chad and myself with our connections and be able to help them, they just can't turn down, like Todd said, the multiples they're getting that we just don't see. Let's put it that way.
Do you think it will level out with everyone else in the future?
I think the paid, you know, day of reckoning will come. I don't know what'll set it off or what event or what it'll do and how much. You know, the balloon goes up and up and up until it pops, and then who knows? But
yeah, we call it the famous Warren Buffett saying, you know, when others are fearful, we're very greedy. And when others are greedy, we're fearful. And right now we're in that time where, you know, everyone's greedy, and it all starts with the public markets. So when you look at the public market SaaS multiples and they continue to go up and up and up, that's greed. And at some point, you know, and that all trickles down to the private equity and venture markets too. At some point, there will be a correction and multiples will come down, but it might be from a much higher level than we are today. We just don't know. But that's why we're kind of moving directionally to not pure SaaS companies, but more subscription anything companies. Like we're looking at a lighting company now, looking at an electrical contracting company that has a subscription model built into it. So we're looking at more traditional businesses, kind of like Brookstone, of what, you know, Perry did on a smaller scale, and trying to convert them to the latest, greatest software, people, and technology really to help run their business.
I don't want to get away from our discussion, but there's a question and answer over here from Jeff Booth. Todd and I were just having this conversation last night about the recent IPOs at DoorDash and Airbnb, and we keep scratching our heads saying, are they really worth $100 billion? I mean, you know, DoorDash loses money every year. I mean, how long do we talk about that, Todd?
Yeah, no, it's crazy when you look at the valuations of Zoom, and I mean, great companies, phenomenal growth, moat technologies and moat market stance. But, when you got to wait 50 years at 100% profit margin to get return of capital, I mean, we're sort of like, the Benjamin Graham modeling, growth at a reasonable price. We're GARP guys in the venture capital world. So we want growth at a reasonable price. And we're not seeing a lot of growth at a reasonable price. We looked at a company recently that was a 15% grower. We were sort of in that 6-7 times revenue range, and I think they were in the middle double digits probably. So,
Well, I love the pivot to open to new ideas.
Yeah, that's what we do. We'll find some new companies that we can create subscription models in, and bring better people, better technology, and create more of a subscription model and increase value. Because those businesses you can buy for 3-4 times EBITDA cash flow. And we can convert them to more of a sexy business model.
Yeah, and you'll help all of the consumers too by offering that. Thank you. So onto our next question, a lot of entrepreneurs want to know where the money comes from. What do your LPs look like?
We've never met them. They're mostly in China.
Really?
The New York real estate market. Come on.
No, they're just friends of ours. I mean, I would say 90% of our investors, or 80% probably, are friends of Chad, myself, and Perry. And
Gotcha.
It's a small group. I think we maybe have 40 LPs total.
Okay.
Where most of the money comes from me, Chad, and Perry. When I say most, probably 40% of the total capital is us three and family members of us three. And then the rest are from a majority of those LPs, those 40 LPs.
No China. Okay.
I'd also say that based on Canal's track record, it's not too hard to get people excited about investing with Canal. Yeah. I mean, Todd doesn't like to use the number, but I think over the last 10 years, it was what % return?
I mean, it was definitely in the top quartile. It's pretty good. Much higher than the S&P.
Well, let's skip over to my last question, which was going to be your success stories, your biggest wins. So tell us about that, because you led me right into that. What were some of your biggest wins that you've had so far?
So there's different ways to define wins. I mean, one is IRR, and another is multiple of capital. So probably a multiple of capital was probably WebPT.
And you were the first investor?
Yeah, we invested $1 million in WebPT when they were not quite $1 million in revenue. They were just under $1 million in revenue. We put $1 million in their first round of capital there. So that was probably the largest multiple of invested capital. As far as IRR goes, we invested in a company that I actually co-founded because we were doing a round. So obviously I let Canal do it. And we made an IRR of, I can't remember, it was like 200 and some %, but we were only in it for a year. So from an IRR perspective, net time probably won the prize. From a multiple of capital, it was probably WebPT, or potentially a company in Atlanta called CallRail. We're still in that in a small way, but when that small piece sells, that could be pretty close to WebPT numbers.
And we have a couple questions from the audience, which I'll get to in just a second. But what made you pull the trigger on WebPT?
I mean, again, it's you just can't believe some of these numbers people are paying. And we sold our position to Battery, and we thought we were getting full value for the business. And very shortly after, Battery Ventures sold it to Warburg Pincus. So, I think we're really good at getting in. I think we underestimate the strength and the velocity and the momentum of the SaaS market.
Good call on WebPT.
You can never go broke taking a profit. So
yeah. Jacob asks, do you guys look unfavorably on a startup that loses money on purpose to expedite growth if they have levers they can flip to turn profitable and have good indicators? Example, 80% margin on a subscription SaaS model.
That's a necessity. They all have to be losing money with high growth, with the potential to flip a switch and get profitable in case the capital markets close and we can't put more money in. So we need a backup plan. We need an emergency plan. So we always have an emergency plan where if the company can't raise capital and the markets are closed, they have to be able to get profitable. Otherwise, you're out of business, right? So
yeah.
So I think his question was, do we look unfavorably? I'd say, no, we don't look unfavorably on those.
yeah, we look favorably.
We look favorably on those.
Yeah.
Just
So
be
Jacob,
at that
you heard it now.
$1 million in revenue, or close to it, or you're on your path towards that.
And Debbie wanted to know, just a practical question. She has a subscription-based product. How do you get an interview or discovery meeting? This is a good
It's
practical
the morning
question.
squeeze. You find us there most mornings. Right?
Free breakfast for a discovery meeting.
There you
All right.
go. There you
Well,
go.
if you'd like to sit down with us, I mean, you can, Laura, you can give one my number, Todd's number, can't you?
Oh, yeah.
So, yeah, do it.
Our email addresses are easy to figure out too. It's just our first name at Canal Partners. So Chad at Canal Partners, Todd at Canal Partners. Great. You send us an email, but if someone didn't know that, they could just go to our website, obviously, and fill out the form. That's how you
Perfect.
contact us to answer it in general.
Debbie, you can also email me, Lauren at Startup Grind.
Hey, we got to fan the morning squeeze, Todd. Jamie likes it. One of his favorite places.
Yeah. We hired Jamie's people from his company, Quick.
Oh, good stuff. I happen to know him too. He's my husband. So let's talk about, Debbie might want to go see you. This is a good question that everybody wants to know. What do you look to see in a pitch, and what do you not want to see in a pitch?
Chad?
Well, first of all, you want to see that confidence that, that they think they have something, they think they have something that's going to be super successful. Like I said before, we like to see someone that's on path to 1 to 3 million. If they're not at 1 million yet, they're growing month over month, and they're going to be on pace to get to that. We like to work with them before. So, even if someone's, well short of that right now, they're local, we're always interested in talking to them and getting to know them and just keep a close eye on it so that when they get close to that level, we're ready to just jump right in.
When's too early?
Too early. When is too early, Todd? I don't know that there's really too early. I mean, we love talking to people, and as long as there's some sort of business going, I think if it's just an idea, that we'd have to really like you to help you with that. But if you got something going, I think we'd love to meet with you.
Well, I think we also, we look at things two ways. We look at stuff that, we like maybe it's personally to invest in that's real early, and we look at things that we think would be good for our LPs. So, some companies that we look at that we think we like are way too early for our LPs because they're very risky. They're, like you said, they're low revenue or, low losing money possibly. But that doesn't mean it's not a great idea. And the three of us, wouldn't mind getting involved. But to get our LPs involved, that's a whole different story because not only do you have to be better and smarter, but you don't want to lose money. Bad enough you lose your own money, but God forbid you lose money your LPs. It's really hard to bring that back. The second thing is I think that when we go to meet with people, we like a pitch where you have an entrepreneur or several entrepreneurs that have a plan. They're confident. They're also open to bringing in somebody as a real partner as opposed to just saying they want money. I think the chemistry between the entrepreneur and either if it's Todd or Chad or me, it could be all three of us, but one of us usually hits it off. And that's really important if we're going to get involved in the deal because money's money. But, when you get down to tough times, it's about who you trust and who's on your team. So I think that has something to do with it also. And then the last thing we've talked about is some sort of realistic idea of what their product and or idea or company is worth as opposed to what people are throwing at them. If you get somebody, again, who thinks they're worth 15 times revenue, but we're not going to get there. So how much we like each other, sometimes they might take less just to be part of Canal, and sometimes they don't.
Yep.
Anything that just you do not want to see in a pitch?
And Jim and I used to laugh at this all the time. Jim Armstrong, we used to laugh at this. We see these 5-year plans where they're doing like 100,000 a year in revenue right now. And by year 5, they're doing like $235 million, making 150 million of EBITDA. And, Jim and I used to save those and laugh at them because, they have no idea. First of all, to go beyond 18 months in a business and modeling that and pro forma the financials out is extremely difficult. Markets change, pandemics happen, crashes happen. So to model something out 5 years and say, we're going to go from 100,000 to like $250 million in revenue and make all this money, it's laughable. So I think being very realistic, and a lot of incubators, Shark Tanks, a lot of these Y Combinators, a lot of these places make you do 5-year projections. And I think it's sort of a waste of time. I think you do 2 years, maybe 3 at the far end, and really focus on that next 12 months. Like whatever you're giving us for the next 12 months as a VC, you got to hit. Like we want to make sure that CEO and entrepreneur hits the next 12 months. Because the worst thing is you give someone millions of dollars and then they drastically miss their next 4 quarters, like drastically. And that's happened to us before. And we had to replace that CEO. So it's just, you really, really want to make sure you focus on the 12 months and make sure those are numbers you can hit with the capital and the team you got in the market you're playing in.
Yeah. Unless COVID.
Yeah. And then there's the braggers, like Perry said. A lot of it's chemistry. People come in and say, I know this person and I did this and I'm this. And, it's almost like a date. It's like, oh God, I don't want to go out with this person. It's like,
yes. So many things come down to dating.
Yeah.
Dating etiquette.
Seriously, it's like, oh God, I can't wait to get out of this meeting. Cause they're like the cat's meow. And you're just like, well, if you're so famous and rich and blah, 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 why are you talking to us?
Yeah. And why have you not asked me a single question?
Yeah. So there's little tells, don't talk about yourself the whole time. Ask questions about us and Canal, like you're doing, our backgrounds. You got to know the chemistry. Like Heidi at Web PT did this beautifully when she interviewed Battery. Like she really wanted to get to know them, and they obviously wanted to get to know her. And it's a partnership. Like you guys, you're going to be one, in the company. And it's like, if you don't like each other, which is okay, not everyone needs to like each other, but find that out early instead of, fooling somebody that you're not. And then you find out later after you're partners now.
Yeah, it's always interesting to see how people react to feedback. And I think the worst case is they don't have any answer. Like they just look dumbfounded when you ask a pretty pointed question, like you stump them. That's probably the worst thing that can happen. And then there's the opposite where they just don't take the feedback or are offended, or maybe your feedback is completely wrong and you didn't see it, so that they need to explain something to you. So it's just interesting to see people's reactions, and I think that's kind of how you get the best feel for how it would be to work with them and how the chemistry would be.
Yeah, and also we want bad news. Like whether we're looking at a deal or we're already in a deal and we're on the board, I always tell our CEOs and founders, give me the bad news first. The good news can wait till after you give me the bad news, because I think it's human nature to want to give the good news first and look like a hero and be like, look at me, and we're going to give a lot of attaboys. We're going to be a lot of pats on the back, right? But we need to know the bad news so we know how to solve problems with them as a team and as a partnership. Because if we don't have all the information, like Perry says, we need boots on the ground. We need all the information to help the company and CEO decide where to go. I mean, it's not our decision. It's really the CEO and co-founders' decisions on where they're going to go, but we want to be kind of helpful in that process.
So to summarize, be open, dating 101, be confident, listen, ask questions, and be realistic with your projections.
And then be focused too. I think it's important that we have a lot of CEOs that have a business plan for a product and they're like, here's what we do. And they're like, but as soon as we get your $3 million, we're going to do this.
We're going to do 12 more things.
We're like, oh, wow. So we've seen that too,
That's when you see Mark Cuban go, no. Quick question from another Lauren. What Arizona-based company is most exciting to you? Can be Canal related or not? Is there any companies right now that you're just really excited about?
That we're currently looking at?
You could be looking at it or not. Maybe one you're looking at it and one that you're not looking at.
I mean, we're looking at one now that's pretty exciting. I can't get into the details, but because we don't have it yet, but we're looking at one that's very exciting. And it's their customers are healthcare companies, insurance companies, the big insurance companies. We like that one. One that we're probably not in. I mean, it goes down to some of these boring old local service businesses that we're looking at, like this lighting company, this electrical company, where these companies are making a lot of money. You can buy them really cheap and they don't use any software. I mean, there's no Slack and Salesforce. And I mean, they don't have some of the basic tools that we take for granted in software companies and SaaS companies. We would try to bring a lot of what we have in SaaS companies to these old line businesses that are literally, doing lighting and electrical and HVAC and hood cleaning and street washing and, companies that are going to continue to grow with the population and the economy, but they don't have the people and the technology to help run their business like we do in SaaS companies to run the KPIs the way we run them.
Yeah.
Well, I don't know. And Chad, you want to add to that?
Well, for me, I mean, the most exciting company is Allbound because I invested in both rounds, and I think I got in before these valuations went bonkers, and it's a SaaS company, and I think it's a great product. It's helps with managing channel sales, and so I'm really excited about that. We put a new CEO in place who's been crushing it, and so for me that's like the big win that I've been the most involved in so far with Canal. So that's what I'm most excited about. We'll see where that one goes.
How cool to get in so early.
Yeah.
Well, yeah, just to add on to what Chad said. So, we invested in Allbound when they were probably 400,000 or 500,000 of true subscription revenue. And we didn't really have a product that worked really well, that scaled. We had sort of a custom product for some large clients. And then we had a situation where the founder and CEO, who's still a good friend of ours, said, I don't want to do this anymore. I don't want to be CEO. I love creating and marketing and doing all these great things, but I don't want to, deal with financials and managing people and hiring and firing. And, so we jointly together went out and hired, another CEO. So I love when the partnership is open and transparent enough to where we can, tell each other our true feelings to make hard decisions. And that was a good example where, that company could have gone south really quickly if he would have held on and did something he didn't want to do. And just, the company could have gone out of business. But instead it's a very valuable company today, becoming a leader in the PRM space, all because of open communication and transparency and our ability to trust each other, to continue to put more capital in and hire a new CEO. And this current CEO has done a phenomenal job. So.
Well, that speaks a lot to how much they trust you. And going on to that, Jeff and Jacob, I will get to your questions. But, when you do invest in a company, you've talked a little bit about this, but I wanted to see if you could expand more on how you help your portfolio companies succeed. I know, Todd, you said you're really interested in coaching. Obviously, that played through with Allbound when they felt like they could come to you. What other ways do you help your portfolio companies succeed after they
clearly our network, for potential customers? I mean, Chad and I have a good friend who's an executive at Fiverr. We just sent them over to Allbound, as a potential customer. They're looking for a PRM. So, I mean, our network of potential customers, employees, executives, agencies, like Chad sent a bunch of our company's potential agencies to use on the marketing SEO side. So I think our knowledge, people we know, and obviously our capital are some of the three ways.
Well, we also have a big group of operating partners if we need to plug somebody in. And if we can't find somebody to plug in, we know how to find somebody to plug in that will fit. We don't just go and hire anybody. We'll make sure that person's a fit for Canal's relationship and the company we're putting them into. So I think that's one of the strengths is the operating partners that we can draw on. And if we can't draw directly on those operating partners, we have resources. They'll help us get to the right people.
Yeah, that's actually a key point, Perry. That is probably our biggest asset, that we have a really good bench of venture partners that we call them, that come in and have lunch or dinner or go spend a day at a company. And typically these people are former CEOs, founders that have had significant exits and have some time to give back and work with some CEOs and founders and helping them navigate the road, the road. So that is a great point. Yeah. And then in Arizona, I mean, there's only one or two other venture, companies out there, but I think in Arizona, if you're taking angel money, you typically don't have a big venture bench, kind of like we have. And it's taken 15 years to build our venture bench. But Chad, Perry, and I all have our contacts that are willing to help based on the need and the particular company.
And you just raised my next question, which was Arizona's known for having more angel capital than venture capital. What do you think we can do to increase more venture capital coming in here so we can raise in our home state versus going elsewhere?
Well, there's a ton of venture capital here. It's just not from Arizona-based VCs. So
that's restructuring.
Yeah.
Thank you.
Yeah. And it's because there's not enough, I call it inventory. There's not enough companies to invest in to do what we do. I mean, if we were a fund, we'd be out of business because we haven't done a deal in 2 years. So we couldn't even pay the bills. I mean, luckily we all had successful exits and we're not taking a paycheck. But people that work for a venture capital firm, they're taking a salary and a paycheck. You got to keep the lights on and keep the payroll going. So you have to do deals and you have to continue to invest, not just in Arizona, all over the country. But there's just not enough companies to put a significant amount of work, significant amount of capital to put out in Arizona alone. There really isn't. It depends. Like a lot of VCs have 3 to 5 million as their cutoff. They won't invest anything less than 3 to 5 million of ARR. I mean, how many companies in Phoenix are looking for capital that are over 5 million of ARR? You could probably name them all in one hand. So it's hard to develop a business model of investing exclusively in Arizona. We would love to just invest in Arizona. We really would. I know Chad doesn't like getting on planes right now.
Not without that mask.
But out of the 15 deals Canal's done, I bet you I would have to look it up, but it's probably half are in Arizona and Phoenix, and the rest are out of state.
Answering my how do you find the ones that are out of state?
It's interesting. Todd mentions if we were a fund. Well, the interesting about funds, if you were a fund 2 or 3 years ago and they're throwing money at work, it worked out pretty well because all of a sudden, however, if you're a fund now and you're throwing money at work, in 2 or 3 years, you may be singing a different song. So it's the fund business versus our type of investing is an interesting concept. I mean, some people love the fund. Some people like to be, touch us, feel like we're going to take care of them like they're part of the team. Whereas if you're a fund, it's like you do what the fund says and take your chances. So it's two different types of investing, I think.
Yeah, and funds put money to work. That's what they do. That's what they're designed for. It's like when you invest in a mutual fund, they buy stocks. They don't ask you if the market's good or bad. They That's what they do. So if the VC market and the stock market and everything keeps going straight up, they'll do fine. But we're more opportunistic and are more protective of, I think, principal and capital. So we're willing to give up some of the upside to protect the downside.
That makes sense. Jeff asked, it's great to hear you talking about realistic planning. Yes. How do you think about a customer lifetime value, and is that metric valuable to you?
I mean, all of our companies have that as a KPI, every one of them. It's a little ambiguous and subjective, I think, because you could say the lifetime value is X, but if the company's only been in business 3-4 years, it's hard to really put a number to that lifetime value. If they have a 1-year contract and you don't have the experience and the history to kind of show what the churn's going to be and what the market's going to do. So the more mature a company is, the more real that number is. But all of our companies try to get our customers to sign multiple year contracts, which will increase the lifetime value. And obviously we want the ACV, the annual contract value, to go up. But it's an important metrics, because when you're trying to figure out how much to spend to get a customer, you want to look at that, because you might lose money for the first year, but the next, 5 years of that customer's life, you make a lot of money. So, if it, like Chad at Yandy, he would spend X number of dollars to get a customer, he might lose money on that first order or two, but they're a customer for life, right, Chad?
Yeah, exactly.
And Jacob asks, I've found expectations on valuation and raises are wildly different depending on where the investor is based: San Francisco, New York, Arizona. My seed round was just under $1 million and considered small by San Francisco guys, but I think it's average to Arizona. As a founder, how do you know how to be realistic but not cut yourself short on opportunity when deciding amount to raise and the valuation of the raise?
Here's an interesting point that most founders and CEOs don't think about. They're so focused on the valuation number, but they're preventing themselves from selling the business when they don't even know that's what they're doing. So if $1 million startup, I actually had this discussion with one of the partners at Benchmark, Bill Gurley, and we were talking about this in San Francisco, and it was like, Bill said, do you know how many, this was going back like 7-8 years. He goes, do you know how many companies sell for over $50 million this year in the US, SaaS companies? I said, no. He goes, 95% of all SaaS companies sell for under 50 million. This is like 2012. Mm-hmm. And I said, really? He goes, so all these deals being done right now at 100 million valuation, 150 million valuation, they're putting themselves in a moat because they won't be able to sell the company. And if the music stops on financial buyers and growth recaps, who are you going to left to sell to? Because strategics aren't going to pay those multiples. Most of the liquidity in the VC private equity market is from one financial buyer to another financial buyer, right? So that works as long as the market's going up and there's a lot of liquidity in these funds. But if that stops, you're back to where it used to be for 50 years, which is you build up a great business and you sell it to a strategic buyer. Mm-hmm. But if you're raising money at such a high valuation that buyers can't show up because you priced yourself out of the market, and the VC, I mean, if we're in a company at a $50 million valuation and they get an offer for $50 million, we're not going to take it. We're not going to make any money. Yeah. And we can prevent a sale. All VCs and private equity guys can prevent a sale. So why would we want to sell a company where the founder might be like, oh, but I want to get 50 million. But yeah, you took our money at 50 million and now you want to sell it at 50 million. We've actually seen that a few times. We're like, no, we can't sell the company and make no money. We're not doing it for free. But they are so excited to get a high valuation because it makes them feel good on the way in. But I love the experienced CEO and founder that says, wait a minute, I don't need to have a huge valuation. I want a fair valuation, but I want a valuation where you guys and myself can make a lot of money and realistic of what the expectations are upon an exit. Because I think it's getting a little out of whack.
Todd, you and I and Chet have this conversation all the time when we're put in a LOI on a company. It's like, what's the valuation? And there's a range. And then we decide, do we want to be the low end of the range or the high end of the range or the middle of the range? And sometimes, we might go to the higher end because if the story is right and we can build it the way we want it, it's a rounding error, but we won't go way out of the valuation range because, like Todd said, we'll just never get there. So in our minds, we have a range. Whether we decide where we are in that range is kind of the guessing game that works or doesn't work. And then if at the end of the day we're right, it was really just a rounding error, and we'll all make a lot of money as long as that range is within the right framework.
Yeah, and in terms of the amount considered small, for us, $1 million is a smaller deal for us. So we look for $1 to $3 million in recurring revenue, and we look to invest between $1 to $3 million. So, so just for your own feedback, I know in his comment he said that it was considered small by Arizona guys. Well, I think for us that's not considered. That's still considered small for us a little bit. So, but I think we're probably the biggest. So 1 million is still small for us. But I hope that answers that.
Yeah, absolutely. And Brenda asked.
Sorry to interrupt, Lauren, but sometimes the best feedback is don't raise money.
Mm-hmm.
We just saw a deal that was growing nicely, never raised capital, got a great business, and he doesn't seem like he seems like a risk adverse guy, CEO and founder. So like his best play might be don't raise capital.
Yeah.
Chad built a $50 million e-commerce business, and how much money did you raise, Chad?
Zero.
Zero, So it's still possible. Everyone thinks they have to raise capital. You can still build the business the good old fashioned way out of customers, out of revenue on customers, and not keep doing, round after round after round. It is more competitive because you're competing against people that have a lot of capital, but it's also very possible to build a business without raising a lot of money or any money.
There you go. You guys heard it here first. Brenda asked, I don't know, Brenda, if I'm just tacking this question on, do you typically lead? I'm guessing she's talking about leading rounds.
Well, our rounds are so small that, they're typically $3, $4, $5 million, and there's typically not a lot of room for other people. But we've partnered with like Tall Wave and a few other local firms, ATI, Desert Angels, some of the local angel groups we've partnered with. But we're the majority of the round. Gotcha.
And since we're getting to time, if anyone else has a question, please pop it in. See, I told you this would go by pretty fast. Hopefully it has for you all. I want to end my last question with any advice that you have for founders, because you've seen so many. What advice do you have to share?
Chad?
As I say, we touched on it before, but I think founders need to stay focused a lot because, like we said, sometimes they're focused on their core business and they got all these ideas in their head. They just can't afford them. And you don't want them to all of a sudden get some money and then lose their focus on their core business. So I think other ideas are great, and ultimately they could be great ideas. But while you're just starting a business and making it grow, you need to stick your focus, stay in your lane, I guess is the best way to put it, and get that business up and going. So then you can tackle some other avenues, but just stay in your lane and get that one business going the way you should get it going.
Chad, what do you think?
I definitely agree with what Perry said. But in the beginning, you might try a couple different things and even a couple different things at once. But then you have to decide, what you're going to focus on. The other thing for me, I think, I self-funded with like $10,000 in savings and started in my garage. So, I kind of believe in that model where in the startup, you got to be lean and you got to be willing to, sacrifice your nights and your weekends and just put your all into it, at least initially, until things are really rolling. So I kind of look for that in the people we talk to, look to see that kind of fire in their belly. And I think, there's only certain people that are meant to be entrepreneurs. I have, plenty of friends that, I grew up with, that I went to school with, that, that life would just never be for that. They're risk averse, or, just like the comfort of the 9-to-5 job, but, so there's a certain personality, a certain person that, wants to kind of work somewhat on their own, right, and do a startup at the same time. Obviously they're going to, if they're looking to partner with us, they're looking to take on some mentorship as well. But you need kind of that independent confidence, and there's super strong work ethic. And so, those are the main things that I think you need to have as an entrepreneur that we look for.
I love the part about knowing if you really are an entrepreneur or not.
Yeah.
A lot of people say they are, and say, oh, you can't have a paycheck for a year. They're like, oh, maybe I'm not.
Yeah. That's a quick switch. No weekends for a few years. Oh.
Yeah. I haven't had a paycheck in 25 years. And they're like, well, how do you pay the mortgage? I'm like, well, I sell things that I invest in.
Yeah.
So, but the one thing I would add to what Perry and Chad said, which were both very valuable, and I agree with points, is you got to have fun. Like most startups that we invest in are 5 to 20 employees. And if you're not a family and a team and having fun and going out for drinks and happy hour and doing like trips together, I mean, it's like a family, and you have to have each other's back. It's almost like you're in the military and you're a unit. And you're not having fun and enjoying life and the company and your coworkers, I don't care how good your product is and how great your market is and how much you've raised, you're not going to win. I mean, there's been great companies like Zenefits, good example. Horrible culture. Everyone was fighting. People were leaving left and right, raised a ton of money, and they just went down the tubes, right? Where other companies in that space had that chemistry and had that, unity and that fellowship, which just created magic. Like I say, our biggest successes, there was magic and chemistry in the room with the founding 10 people, 15 people.
Yeah.
And they're not leaving because they're all going to get picked off. Great engineers, great CMOs, great VP of marketing. They're going to get picked off weekly, if not daily, by recruiters. If they don't want to be there, they're going to leave. So and it's not just about the money. They have to really want to be there.
Yeah, that's a great point.
One of our last questions.
More unique of a person, right? Because you have to be this person that's super motivated, hardworking, but you have to be able to lead in a way where you got to realize, some of your, you might expect your partners to be at your level, but if some of your employees are not going to be quite at that level, no matter how much you motivate them, and if you make too harsh demands on your employees, you're going to run them into the ground, and they're going to get picked off by like Google and go take naps in a pod somewhere or something. So, you got to get people to work hard, and keep them motivated and keep them happy. And I definitely, from my experience, we try to treat everyone like family, like Todd said. I know Todd's done that with his businesses, and it instills that culture in the companies that we invest in.
I love that. So any founders out there, 5 to 20 people, better seem like a family and a functional family. We'll wrap up unless anyone has any other questions with Jeff's question. And I have a few little fun personal things at the end. What industry or business model do you think has a great opportunity to pivot towards subscription model other than electric and some of the other ones you were talking about?
Is he going to compete with us?
No threat. Just a fan.
No, I think it's just boring old service businesses. I own some restaurants, and you have to get your hoods cleaned twice a year. It's a law. It's not optional. So like hood cleaning, HVAC, lighting, they're moving, not just us, but they're moving more towards subscription-based companies than they were in the past. Before it was just like fee for service. I come out, clean your hood, I send you an invoice. And most of them are still done that way, but the smart ones that are really, I think, capturing market share are doing more subscription-based services. I have Chaz Roberts here at my house. I have 6 HVAC AC zones, and I can't keep track of what's going on. So I just pay them on a subscription model, and they come twice a year and check all my units in my house. I don't have to think about it. I don't have to worry about it. They schedule it, and it's a subscription model that really didn't exist up until the last few years. So boring old businesses. Just think boring old businesses, lighting, HVAC, hood cleaning, power washing, window cleaning. I mean, you know, even Chewy has, I mean, not Chewy, WAG has a subscription model where you can choose like how many times you want your dog walked. And, you know, so dog walking is a subscription model. It's
the guys that service your pool is a subscription.
Yeah, that's a subscription model.
You're paying them, and they're just showing up once a week to clean your pool, and you don't even think about it.
So those should trade at 10 times revenue, not 3 times EBITDA.
You guys have been doing it for years. They've been locking people in for years, especially on the East Coast.
So Jeff, just think boring. Anything you see that's boring that you wouldn't think, dig into that, but no threat. Well, to wrap up tonight, so everyone can get off and get some dinner or feed the baby, I'm going to ask you just a few personal questions just to wrap it up. So Perry, I'm not sure if Chad and Todd are golfers too, but favorite golf course in Phoenix?
Wow. Well, I have to say, since I just joined Arizona Country Club, that's my favorite. But that being said, north of here, I mean, you have Whisper Rock, you got Troon, you have Troon North, Estancia. I mean, the stadium course over and when they play the tournament is a lot of fun to play when, you know, when the stands, well, actually when the stands are there or not there, that's a fun course. I mean, this area has, you know, 20 top 100 courses. So, I mean, you really can't go wrong.
Todd, Chad, golfers?
No.
No? Okay. Well,
yoga. He knows about yoga.
Oh, I do too. I love yoga. Todd, what about you? What's your fix since you founded Raw? What's your favorite sushi?
You know, I've been going to Geisha Go-Go a lot, and I like Sushi Roku in the W. It's very good.
So good.
Yeah.
Hero, also little strip joint.
Yeah, I like Hero. And then, you know, there's a local place right by my house called Sushi-aholic, which is pretty good. A little hole in the wall on 40th Street in Camelback. So, you know, I try to avoid the big chains. I like the independents.
Yeah.
What about Roca Core? I know it's not a.
Yeah, Roca Core is very good.
So good.
I mean, you got a mortgage to go there, but it's good.
Yeah.
You know.
And Chad, for you as a new dad, best part about being a new dad?
Sleeping good night.
I don't get to sleep.
I know.
It will be the best part.
The
best part about being a dad. Don't worry.
Yeah. Well, so far, you know, since hearing you say dad, hearing her laugh, and for whatever reason, I don't know if this is a normal thing, but my little girl has laughed since she was like 2 weeks old. Her first word really was "heh heh," and she still does. Like she'll see someone and just go "heh heh," and wait for them to respond with a laugh. And she did it to Todd the first time she met him, and they were just going back and forth, laughing and laughing and laughing. So definitely her giggle is my favorite thing.
Harvard, here she comes.
Someday in person, we'll all meet. But until then, gentlemen, it's been a pleasure. It was a great last event for me. Thank you so much for taking your time tonight to answer some of our questions. And you heard it here. You got all their emails. So if you want to rewind this when I put it on YouTube, you can just go back. But if you have any questions for them, please reach out, Canal Partners. And we'll look forward to seeing everyone in person at some point and raising a glass. Thank you all.
Thank you, Lauren. Great job. Appreciate all you do.
Congratulations on your last.
Yay! I'll still be volunteering. Don't worry. Right. I'll still be here. Have a great evening. Thank you all.
Bye-bye.
Bye.